The Indian stock market is on a roll. Both SENSEX and NIFT scaled new heights after a blistering rally in late November and early December this year. The SENSEX and NIFT reached a record high on 1st December 2022. SENSEX at 63,300 and NIFTY at 18,800. Since then, though the market has cooled down a bit, it's still at higher levels than in the past, well above the previous all-time high in October 2021. Seeing the stocks quoting at a premium in a bull market like this, the temptation all around is to invest and make some quick money while the rally lasts. But should you really invest in a rallying market like this? What you should do and what you should not do. Welcome to Nana's Learn Better. Use this channel to enrich your knowledge in personal finance to take informed decisions. Do subscribe to the channel if not done already. Often you cannot clearly explain why the stock market is rallying. It's difficult to fathom the reasons for such a rally. For example, especially on the backdrop of slowing GDP growth in India. The GDP growth slowed down to 6.3% for the quarter ending September 2022. But one thing is certain from the history. The rallying has to end at some point of time. In general, a rallying stock market is a signal to book profit and wait for dips to re-enter the market. So, if you are a short-term investor, do not wait but book profits and get away from the market for the time being. And do not chase the market by taking new positions. You can always re-enter later. After all, what goes up has to come down, right? However, if you are a long-term investor, the SENSEX and NIFTY hitting all-time high should not be a concern to you. Avoid the temptation to exit and book profits because you are in the market for reaching your long-term financial goals. Stay calm and stay invested. However, you can do a couple of things that will help you to do better in the long run. 1. Look at your portfolio and weed away the duds. This is the best time to have a real hard look at your overall portfolio. Sell the ones that are laggards even in a red hot market like this and shift the money to debt instruments so that you can re-enter later when the market has cooled down. 2. Do not make any new investments. However tempting it may be, do not invest on anything new. In a worst situation, do not make any bulk investments at least. 3. Resist the temptation to sell. Even for a long-term investor, the temptation would be to sell and make profits with an idea that you can always invest afresh later when the market has slowed down. It's easier said than done. Once sold, you may not be really able to time the market to re-enter. So, hold on to the stocks that you want for the long term. If you are a new investor, this is the time you should be very cautious. The rising market will always be a temptation. So, don't be lured by the short-term gains in the market and don't make the mistake many others would do. Just stay away from the market and wait for the market to cool off. But all said, it's one's own preference and outlook. Always align to your investment goals and strategies. Better be cautious than being sorry. See you in another video. Till then, this is Narayanan Viraya from the channel Nana's Learn Better.